Have you ever looked at a sunflower and wondered why its seeds spiral out in such a perfect pattern? Or marveled at the delicate curve of a seashell? What about the way a stock price seems to bounce between certain levels? These seemingly unrelated things are all connected by a fascinating mathematical sequence called the Fibonacci sequence. Centuries ago, a brilliant Italian mathematician named Leonardo of Pisa, better known as Fibonacci, stumbled upon this sequence while studying the growth of rabbit populations. What he discovered wasn't just a mathematical curiosity, but a fundamental code that underpins the very fabric of our universe. Fibonacci's work might seem a million miles away from the fast-paced world of stock trading. But believe it or not, his sequence is now used by traders around the globe to try and predict market movements and make smarter investment decisions. Intrigued? Let's dive in and unlock the secrets of Fibonacci together. So who was this Fibonacci fellow and what exactly did he discover? Born in 1170 AD, Fibonacci was a mathematical rock star of his time. He traveled the world, soaking up knowledge like a sponge and bringing Eastern mathematical concepts to Europe. His most famous contribution? The Fibonacci sequence, of course. This sequence starts with 0 and 1, and each subsequent number is the sum of the two preceding ones. 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on, stretching towards infinity. The real magic happens when you divide any number in the sequence by the one before it. You get a ratio that hovers around 1.618, a number known as the golden ratio. This ratio, often represented by the Greek letter phi, pops up everywhere in nature, from the arrangement of petals in a flower to the spiral of a hurricane. And, as we'll soon discover, it plays a fascinating role in financial markets too. Look around, and you'll find the Fibonacci sequence and the golden ratio hiding in plain sight. The number of petals on many flowers, the branching patterns of trees, the arrangement of seeds in a sunflower all follow this mathematical blueprint. Take a nautilus shell, for example. Its spiral shape is a perfect example of the golden ratio in action. Each chamber of the shell is approximately 1.618 times larger than the one before it, creating a beautiful logarithmic spiral. The human body isn't exempt from this mathematical marvel either. The proportions of our limbs, the structure of our DNA, even the way our ears are shaped, all exhibit elements of the golden ratio. This recurring pattern suggests a fundamental harmony and balance inherent in the natural world. And it's this very harmony that traders try to tap into when using Fibonacci tools in their analysis. Fibonacci on Wall Street. Trading with the trend. Now, let's bring Fibonacci from the natural world to the concrete jungle of Wall Street. You see, traders are always looking for an edge, a way to predict where prices might go next. That's where Fibonacci comes in handy. In technical analysis, traders use Fibonacci ratios to identify potential levels of support and resistance. Think of these levels as battlegrounds where buyers and sellers clash. Support is like a floor where buying pressure tends to overcome selling pressure, preventing the price from falling further. Resistance, on the other hand, is like a ceiling where selling pressure tends to overpower buying pressure, stopping the price from rising higher. By applying Fibonacci ratios to a stock chart, traders try to anticipate these turning points in price action. The most commonly used Fibonacci tools are retracements and extensions. Retracements help identify potential support and resistance levels within a trend, while extensions project potential price targets beyond the current trend. Support, resistance, and Fibonacci, finding your trading edge. Let's say a stock has been trending upwards. Using a Fibonacci retracement tool, a trader can identify potential levels where the price might pull back before continuing its upward journey. These retracement levels are calculated using the key Fibonacci ratios, such as 23.6%, 38.2%, 50%, 61.8%, and 100%. For example, if a stock rises from $10 to $20, a 38.2% retracement level would be calculated by taking 38.2% of the $10 price increase and subtracting it from the high of $20. This would give you a potential support level around $16.18. Similarly, Fibonacci extensions help traders identify potential price targets once a breakout occurs. These extensions, such as 127.2%, 161.8%, and 261.8%, are calculated by extending the retracement levels beyond the previous price swing. Remember, Fibonacci tools are not crystal balls. They don't guarantee future price movements, but they provide valuable insights into potential areas of support and resistance, helping traders make more informed decisions in the ever-changing world of finance. Put the Fibonacci tool in your toolbox and use it to find the support and resistance. But keep in mind that you need to look at more things than just Fibonacci. Thanks for watching, and good luck with your trading.